Greetings, everyone. This is Chapter 5, Part 2, and we will continue our coverage on inventory costing. We left off with FIFO. Now we'll go and start LIFO. So let me get my screen here with you. I'll share my screen. There you go. And I'll start my PowerPoint. All right. Last in, first out. When you think of LIFO, you think barrel of nails. You know, you don't dig deep for the oldest nail. You take the newest nail that's on top. So what we're saying is that most recent costs are going to be in cost of goods sold. That means the oldest cost will be going into ending inventory. So let's take a look and see how we do this in perpetual system. Okay, you're going to have to set up this goods purchased. That's in cost of goods sold. That's out, and ending is what's left, right? Okay, so we'll begin with putting in our beginning inventory. And that's our first layer for the ending inventory, right? All right, good. And then on the 10th, we sold 100 units. So we know that we have to choose from the 100 units from this layer. We only have one layer, so we'll do that. That's 100 at 6. So our cost of goods sold would be $600. Now, we had 140, and we used 100 of them. So now we only have 40 at $6. So now our new layer is only 40 units at $240. Now, on January 20th, we acquire 60 units at 5. So let's put that in. Okay, now what we're going to do is we're going to add this layer to our existing layer. So let's just copy this down. That's our original layer from before. And now we're going to add this layer of 60 at 5. So now those 100 units are going to be valued at $540. On January 25th, we sell 80 units. Okay, that's easy. 80 units. Oh, well, it's 80 units. That's not that. Let me backtrack here. Yeah, it's 80 units. But which ones did we sell? That's the problem, right? So, well, because it's last in, first out, what was the last one in? It was the 60. So that's why we're choosing 60 here, right? If it was FIFO, we would have chose the 40, right? But this is LIFO. So last in, first out. So we're going to use 60 of these. And then we still need 20 more, right? So we got that layer done. So we can, now we have to use 20 of these of the 40. Yeah, I guess it's showing you that we're using up that whole layer. Okay, and then there you go. We're using 20 of those 40. Okay, so now our cost of goods sold is going to be $420. Now, what's our ending inventory? Well, you know, of this layer, we still have 20 of them. And then this layer, this 60, well, we used them all. So we don't have any in that layer. So the 20 units in ending inventory will be valued at $120. See how we did that? In LIFO, last in, first out. So that's why we chose the 60 and not the 40. Now, like I say, in FIFO, we would have went 40. but because it's LIFO, we have to use the last in first out. So we use that, and then we need another 20, and we use it that layer here of 40. Yeah, the 20 of those 40 there. Okay, enough said. Now we're going to go to the January 30th purchase, and we purchased 180 units. That's cool. So we're going to add that to our existing layer, and we only have one really layer of 20. Now, this is the publisher slide, and they're kind of wacky the way they present it, but I think they're going to drop this 0 down, even though it's gone, but I guess it's showing you that it's gone. So anyway, we're going to go the 20 at 6, bring that layer down. Okay. And I would just go ahead and bring this layer over here, but they're going to show you, well, this layer is gone. Okay, fine. We'll do it. Okay, so that's a copy job down here. Now we need to add our new layer, what we just purchased, 180 at 450. Okay, so then those 200 units will be valued at $930. That's our ending inventory balance. So what's our cost of goods sold? Well, 600 plus 420 is 1,020. And if we want to do our little proof thing, we know that beginning inventory was 840. We know our purchases of 300 and 810 is 1110. So the goods available is 1950. So we had 1950 available. We only had 930 left in ending inventory, right? So what did we sell? Well, not 1950 minus ending inventory of 930 would give us our cost of goods sold of 1,020. And there it is right there. Okay. Let's go ahead and use our handout and do the LIFO portion. So let me go ahead and end the show. And I'll bring this over. Okay. So this is LIFO, right? Last in, first out. This is very similar to what we did for FIFO, except now we're going to do it for LIFO. Okay. So if you recall that, we began with beginning inventory of 320 units at $3. So we're going to put that in for you, right? So on January 1, 320 at $3. So our beginning inventory balance is 960. Now, just remember that we will be selling 350 units, and that 150 units will be remaining in ending inventory. Well, let's play this out. Okay, so we have beginning inventory of 320 units at 3 for 960. Then on January 9, we purchased 80. So under goods purchased, 80 at 320. So what we'll do is we're going to add that to our existing layer. So we'll bring what we had before down here. Then we add another layer of 80. Now, trust me, if you costed that out, that's 1,216. Okay, on January 25th, we purchased another 100 at 334. Okay, so under goods purchased, 100 at $3.34. So we're going to add another layer. Let's bring our existing layers down. The 320 at 3, the 80 at 320. It's really a copy job. This is my favorite part because purchasing is pretty easy. You just kind of add to the layers. Okay, so then once you have what we had before, we add our third layer of 100 at $3.34. And trust me, if you costed this out, it's 1,550. Now this is where it gets interesting, because on January 26th, we sell 350 units. Well, which are they? Well, which ones we sell? Remember, this is last in, first out. The last one in was the 100. So we're going to go ahead and use that one, right? So 100 at $3.34. That wipes out that layer. We used it, right? That's why there's nothing here. And we got to keep doing this until we get our 350. So we go to the next layer and we'll use that layer too, 80 at 320. Okay. That layer is gone. The only layer we have left is this one, the 320 at 3. Now, notice here we already have 180 units. We only need 170 more. So we're going to use 170 units of this layer here, which is 320 at 3. So we're going to use 170 units at 3, and we can cost that out. And if we add them all up, our cost of goods sold is going to be $1,100. Okay. Now, as I said, that we used this layer up, so it's 0. We used this layer up, it's 0. But we do have a partial layer of this, right? We had 320 units. We used up 170. So we still have 150 units at $3. And we cost that out. Our ending inventory is $450. Okay. How about that one? All right. The next one we're going to do will be the weighted average. But before we do that, I'm going to go ahead and do some PowerPoint here. Okay, as you recall, the weighted average method, we have to do a calculation that calculates the average unit cost, right? And that formula is, cost of goods available for sale divided by the units on hand. I like to say amount available divided by the total units on hand. Okay, well, let's see how this plays out in the perpetual system. Same scenario as far as the what happened, what we purchased, what we sold, and all that. So we start out again with beginning inventory, 140 units at $6. That becomes our ending inventory, right? All right, now we sell 100 of them. Okay, well, this is pretty easy because we're going to sell 100 of them, and it has to be, from here. There's only one layer, so the average cost is going to be $6. It has to be, right? Okay. So then what do we have left? If we had 140, we sold 100 of them, we have 40 left at $6. And so that's going to be $240. Okay. The next one is on the 20th, we purchased 60 more. Okay. Good. So what we need to do is we need to add this to our existing layer, right? So we got to bring this down, and we'll bring the new layer under it. Now, the thing is, I think eventually we're going to need the average cost, because now we're going to have to average these out. So we've got 100 units at 540. So you can kind of eyeball that. So what's the average cost? Well, it looks like it's going to be, if it's 540, total amount available divided by the total units, that's going to be like $5.40, right? $5.40. Is it going to give us that? It doesn't look like it. Okay. Well, let's go ahead and we're going to sell 80 of them on the 25th. Okay. So what would that be? There it is, the 540. Where did I get that? The total cost, the amount available, divided by the total units. That on average, a unit is cost us $5.40. So that's what we're going to use. Let's cost it out. 80 times 540 is going to be 432. So we'll go ahead and bring over our ending balance. Remember, we had 100. We used 80, so we only have 20 left. And it's funny how they did that. They went ahead and well, they should have went this 540 and then did it this way, 20 units times 540, because that's what we have, right? Of this 100 units, they were average cost was 540. So now we only have 20 of them, right? We have 100 that we had minus 80 that we sold. We have 20, and those were still, valued at the 540. Okay, now let's go ahead and do the January 30th. Okay, 180 at 450. Well, what's our ending inventory? Well, let's bring down our existing inventory, the 20 units at 540. And we're going to add that layer, the 180 at 450. That's cost out at 810. So we've got 200 units that that's cost us $918. Okay. So to figure out, well, what the average cost would be, you would just go the 918 divided by 200 units would give us our 459. Now, what's our cost of goods sold? Well, it's pretty easy. 600 plus the 432 would give us our 1032. Okay, let's do the side calculation again. Same thing. It's like the other ones. Beginning inventory, 840. Purchases would be the 300 plus the 810. So that together is 1,110. Added up, the goods available is 1950. So if we had any inventory of 918 left, that must mean that we sold 1,032, right? 1950 minus 918 is 1,032. And guess what? It ties out with that. So we are correct. Okay, let's go back to our handout. Stop the in show here. And here we go, weighted average. Remember, in your handout, because you should be writing this down, because you have I gave it to you to print out so you can go with me. Here, make sure you put in goods purchased, put in, and cost of goods sold is out, and inventory balance is what's left. I do that in my face-to-face class. So when they do this, they write that in. Goods purchased in, that's what came in. Cost of goods sold out, that's what went out. And what's left is the inventory balance. Okay, let's do the same thing. It's interesting. It's really the same calculations except at the end. So if you'll notice that we have beginning inventory on January 1 of 320 units at $3. So I kind of give that to you there. On the 9th, we purchased 80 at 320. So what we need to do is we need to add to our layer. So we'll go 320 at 3 and bring that down. That's our original layer. It's a copy job. And then we add a new layer to it, 80 at 320. Now, trust me, if you cost that out, that would be 1,216. And how do I get this average cost of $3.04? Well, it's going to be the 1216 divided by, in this case, we've got 400 units, right? 320 plus 80, 400 units. So take the $1216 amount divided by the 400 units, and you'll come up with the average cost of $3.04. Now, on the 25th, looks like we purchased more. We purchased 100 at $3.34. All right, well, let's bring down our two layers, the 320 at 3, the 80 at 320. And then, of course, on the 25th, we purchased 100 at $3.34. We'll add that one, that new purchase, to and make a third layer here. Now, again, the average cost would be, if you costed all this out, trust me, it's 1,550. And how many units do we have here? Well, there's 320 plus 80 is 400, another 100, that's 500 units, right? So 1,550 divided by 500 units, we have an average cost of $3.10. Okay, now on the 26th, we sell 350 of them. Okay, so on the 26th, we sell 350 of them. And now what are we going to sell them at? Well, at our average cost of $3.10. So just go 350 times the $3.10. So our cost of goods sold will be 1,085. Now, we have 500 units available up here, right? Of that 500, we sold 350. So we have 150 left, right? 500 minus 350 is 150. That's what we have left. And we're going to value that ending inventory at average unit cost, which is, again, 3.10. So our ending inventory is 465. Okay. Let me get my bearings here. All right. I'm going to be teaching you things that you're going to use when you become millionaires, right? I'm going to give you some helpful hints to minimize your tax liability. Yes, you too can be a millionaire and pay no taxes. That's right. You too could be a millionaire and pay no taxes. Well, that's not really true. It's kind of funny. That's from a Steve Martin skit. Steve Martin is an old comedian that was pretty fun to watch on Saturday Night Live. Anyway, that the inventory costing methods may give us different results because prices always change, and generally prices go up. So we're going to focus in on prices going up. Okay, but anyway, look here. We have a company. We're going to have exactly the same transactions, the same inventory and everything. But notice that depending upon what method you use, you're going to get a different result. For instance, if you use FIFO, your cost of goods sold is going to be $4,570. But look at LIFO, it's going to be more. Their cost of goods sold is going to be more, $4,730. Now, why would that be? Well, in times of rising prices, LIFO is going to have larger cost of goods sold. And we're going to discover that that's kind of a good thing for rich people because you can minimize your tax liability using LIFO, and I'll show you that. But why is it different? Well, in terms of rising prices, the older, lower costs are in the FIFO's cost of goods sold, right? So you use the oldest cost into your cost of goods sold. Well, in LIFO, last in, first out, you use the higher, most recent cost in cost of goods sold. So that, because the LIFO has more cost of goods sold in there, notice that net income is lower. So the rich people like to use LIFO because it shows less net income. What's that mean? If less net income, less taxes you have to pay, right? Your tax liability will be less. So, so here in FIFO, net income is 721, but in LIFO, it's 609. And I'm telling you, it's the same company, it's the same transactions, it's the same inventory, same everything, but you're going to get a different result depending on what method you use. Now, as a general rule, the weighted average method smooths things out. That's always good. The results are always going to be between the extremes of FIFO and LIFO. And I think that's why, like QuickBooks uses it, because, you know, if for inexpensive programs that you can only have one method, they're going to use weighted average because it's the middle of the road answer. But I tell you what, the rich people will want to go for LIFO because they want to minimize their tax liability. And we'll talk about that. Okay. Anyway, once you write this down, when prices are rising, LIFO has higher cost of goods sold and lower net income. Why? Because in times of rising prices, you know, the most recent higher costs are in cost of goods sold. And if your cost of goods sold expense is higher, then your net income will be lower. Now, for income statement presentation, that's a good thing because you're matching the current expenses against the revenue, right? So it's better for income statement presentation. Again, it's because the current costs are in cost of goods sold. But the main reason why the rich people use it is because it can lower your income taxes. So lower net income, lower income taxes. Now, what about FIFO? It has lower cost of goods sold than LIFO, right? Why? Because the older cost that are lower, because, you know, it'd be the prices were lower, it will have the lowest cost of goods sold. And if it has the lowest cost of goods sold, that means in FIFO, you're going to show higher net income. I guess that would be good if you're trying to impress the bank. And you say, well, man, can I do one method for the bank and one method for the IRS? Nope, you can't do that. They're on to you on that. So still, the rich people will just say, fine, you know, I'll just have lower net incomes. I'd rather save money in taxes. So they'll go for LIFO. Now, when you think about FIFO, it's better for balance sheet presentation. Why? Because the current cost, the newer cost, are in inventory. Remember, first in, first out. So the older, lower cost went to cost of goods sold. That means the most recent cost and the higher cost are in the inventory. And that's good because then you're showing on the balance sheet the true cost of your inventory. Okay, in terms of rising prices, FIFO reports the lowest cost of goods sold. Like I'm saying, is first in, first out. The lower, older inventory is going out. So notice that LIFO is going to be 20. Why? Because it has the most recent cost going to cost of goods sold. Okay. And notice here that the weighted average method, it's always going to be in the middle. Okay, let's focus in on this, the the FIFO. FIFO has the lowest cost of goods sold, but it's going to have the highest net income and the highest inventory balance. Okay. This might be good if you want to impress the bank, but most of the rich people don't care about that. They want to keep their money for themselves. So notice here that LIFO, yeah, it's the highest cost of goods sold and the lowest net income, and looks like it's the lowest inventory balance. And that's kind of true. Let me tell you, you think about the barrel of nails. You know, you always take the nails from the top. Well, the nails at the bottom of the barrel could be there for years because you never take enough out of the barrel to get to the bottom of the barrel. So you could have really, really old cost in your inventory on the balance sheet. That's a problem with LIFO. Okay, let's talk about LIFO. In period of rising prices, it has the highest cost of goods sold. Why is that? The most recent, and higher cost are going to cost of goods sold. That means that your net income is going to be lower, right? You have the highest cost of goods sold expense, so you're going to have the lowest net income, and you're going to have the lowest inventory balance. But the rich people are really into this. They use LIFO because it has the lowest net income, which means the lowest tax liability, so they don't have to pay as much taxes. Now, if you find that helpful when you do it, when you get rich and you're saving all this money, well then, throw your old professor a bone and buy him his red Porsche Turbo Carrera, okay? Because that is a good tip to know. The cost flow method that often parallels the actual physical flow of merchandise is it'd be the FIFO. Most likely, you want to sell your oldest merchandise first, right? The first one comes in, you want it to go out. But check this one out. Okay, this is for my millionaires. You want to be a millionaire? Well, can you answer this? In a period of inflation, the cost flow method that results in the lowest income taxes is the LIFO method. I would love to have a survey to see which of you guys got that, because those are going to be my millionaires, right? And remember, you millionaires, future millionaires, I want a red Porsche Turbo Carrera, right? So just remember that. Look me up, and I will graciously accept it for my help for you to save all this money in taxes. Okay. Yeah, this is kind of good. The first in, first out. This is really good for balance sheet presentation because the ending inventory approximates current costs. So when you think first in, first out, think good balance sheet presentation. How about last in, first out? This is good for good income statement presentation. Why? Because the cost of goods sold approximates current cost, right? The newest and higher costs are in cost of goods sold. And then the weighted average smooths it out. Okay. All right, I'm going to go ahead and stop my presentation here. And I'm going to go to let's see. I want to go to the FIFO. There it is. I didn't have you print this one out, but if you want to, you can, because it really does help you understand. It does a recap. I don't think I'm going to do a Kahoot with you because we're just doing videos, but in my face-to-face class, we're going to do a Kahoot on this. And this is one of those cheat sheets that they're going to use to actually answer the questions. So anyway, in FIFO, the oldest lower cost go into cost of goods sold, right? That means the most recent cost go into ending inventory. So it's the best balance sheet presentation. Now in LIFO, the most recent costs are in cost of goods sold. It's the most recent ones, right? So because it has the most recent cost, it's the best income statement presentation. And I'm telling you, in times of rising prices, that these higher, most recent costs are going to make cost of goods sold higher, which means higher expense, which means lower net income and less tax liability. That's why the rich people like it. Okay. All right. Let's take a look at these questions here. I have the answers, so I'll just show them to you. In a period of rising prices, which inventory method, LIFO, weighted average, or FIFO, will give the lowest income tax expense for the firm? Okay, I said use the table above, and you can see that. You can look at it. I'm just going to give you the answer here, though. It's LIFO. LIFO includes the most recent and highest inventory cost in cost of goods sold expense. That means lower net income and lower taxes. True or false? FIFO costing assigns the most recent purchase cost to ending inventory shown on the balance sheet. Well, it's true. In FIFO, the first ones in are the first ones to go out. So the most recent costs are in ending inventory. And finally, number 3, we know it's true, but let me read this to you. The FIFO, LIFO, and weighted average inventory costing methods are based on assumed cost flows that are not required to reflect actual physical movement of merchandise within the company. That's true. You think about FIFO and the milk display case. Yeah, the grocery store might have their milk on FIFO because they want the oldest milk to be sold first, right? But we know guys like you and me, we reach far as we can in that case and try to get the freshest milk. So these methods, FIFO, LIFO, and weighted average, are just assumed cost flows. They may or may not follow the actual flow of goods. The only one that's not a cost flow assumption is the specific identification. Why? They don't assume anything. They tell you what is in ending inventory, and there you know which ones were sold. Okay. All right. Let's try a quick study, 519 on page 230. Okay. Here's the answers, but let's kind of talk it through. 230. Okay, 519. Identify the inventory costing methods which best describe each of the following separate statements. Assume a period of increasing cost. 1, results in the highest cost of goods sold. That's LIFO. Why would LIFO give you the highest cost? Because in terms of rising prices, then those newer, higher costs are put to cost of goods sold. Yields the highest net income. Well, that's FIFO. Why? Because FIFO matches the oldest, lowest cost in cost of goods sold. So lowest cost of goods sold expense means highest net income. Now, you might have to pause the video and kind of think about that a little bit. But anyway, I just told you the answer and why it is. 3, has the lowest tax expense because reporting the lowest net income. That's LIFO for you millionaires or future millionaires. Why has the lowest tax expense? Because LIFO matches the newer, higher cost, the cost of goods sold expense. So higher cost of goods sold expense, lower net income. Lower net income means lower tax liability and lower amount of taxes you have to pay. Again, LIFO is like a tax shelter for the rich. Number 4, better matches current cost with revenue. Again, that would be LIFO because, you want to match the most current cost, right? Well, to against the revenue. Well, that's LIFO because the newer, most current cost are matched against those revenues. So it's LIFO. And 5, precisely matches the cost of items with the revenues they generate. Specific identification. Yeah, there's no cost flow assumption there. They tell you, which ones were sold and which ones are still in inventory. It's kind of like, you own Selma Honda, that you sold that particular Honda Accord, right? In cost of goods sold. And that other one you bought, well, it's still there as an ending inventory. So that's why it's not a cost flow assumption. You keep track of it individually. Remember, you can't do that for like grocery items, like cans of green beans and things. But for unique, one-of-a-kind items, usually they're expensive. You can use specific identification. Okay. Yeah, there's this thing called the consistency principle, and it just requires a company to use the same accounting methods, period to period. That's so that they can be compared across periods. So you can't say, "Oh man, this time I'm going to do FIFO, but now I need to do LIFO because I need to minimize my tax liability." You can't keep going back and forth. They won't let you do that. Okay, I mean, if you have to do it, you've got to have a really good reason for them to do that. Yeah, the Internal Revenue Service requires that when LIFO is used for tax reporting, it must also be used for financial reporting. This is called the LIFO conformity rule. Yeah, so in other words, they want to avoid, okay, you show us this net income for us at the IRS, but then you show a higher net income to your bank. We're not going to let that happen. And the rich people go, fine, we'll use LIFO because we don't want to pay the taxes, and we'll just have a lower net income to show the bank, and hopefully we'll still get our loan. Okay. Let's talk about this lower of cost or market. So when the value of inventory is lower than its cost, you can write down that inventory. This is an application of conservatism. And when I mean market value, we're talking about replacement cost. So when does that happen? When your inventory cost is lower than market? Well, it could be because of obsolescence, right? You buy it and all of a sudden it's obsolete and the value has gone way down. So you can write it down. Okay. So how does that work? Well, for each, well, you can do it per item or per category. We're going to do it like this, just, one for flat screen TVs, one for satellite radios, one for DVDs. And we're going to assemble what it cost us and then what the market says. Okay. And then we're going to use the lower of cost or market. So those flat screen TVs cost us 60,000. Well, technology moved ahead, and now those flat screen TVs, it's now 55,000. So we're going to write it down. So we're going to use the lower of cost or market. So we're going to use 55,000. For the satellite radios, cost is 45, market's 52. We're going to use cost. For DVD recorders, 48,000 versus 45,000. Well, market is lower than cost. We're going to use that lower cost or market. So we're going to use the 45,000. And then DVDs cost us 15,000. Now it's the market's only 14,000. So we're going to carry the DVDs now at 14,000. Add them up. That's our total inventory cost, the lower of cost or market. Now, what's going to happen is we're going to have to reduce our inventory cost down to that. So, and I'll show you that journal entry in just a second. Again, this is a lot of information here. Just remember that market is defined as current replacement cost. It's not the sales price. Market is defined as current replacement cost. That's important. Okay. When I was telling you that you write down the inventory, well, right now, this inventory cost us 220,000. And but applying that lower of cost or market, we say our inventory should be held at 190,000. So we have to write down 220 down to 190. So that would be, it has to be written down $30,000. And it looks just like that shrinkage adjusting journal entry, right? You're going to reduce merchandise inventory by 30,000. And the offset will go to our cost of goods sold expense. Now, in your book, this is how you're going to figure out cost of goods sold. You're thinking, man, this looks more intense than what you just showed me. And it is. But in my other one, like I just gave you a lot of the calculations, but you think about it. You've got 20 units, and then they give you a cost number and a market number. So when you do the cost number, you just take the 20 units times the 8,500 to get the total cost. Now, to get total market, take the 20 units at the market of 7,000 and you get the 140,000, right? So then now you take a look, well, which one are we going to use? The cost or market? The 170 or the 140? We're going to use the lower of cost or market. So that's going to be 140. Again, in the sprint, we have 10 units that cost 5,000. So what's the total cost? 10 units times 5,000 is 50,000. Okay. Now to get the market, the 10 units times the 6,000 will give us 60,000. Okay. So in this example, they're just making you work a little bit harder to get the total cost and the total market. Anyway, here, which one are you going to take? The 50 or the 60? Well, you're going to take the lower of cost or market. So you're going to take the lower one, 50. And that's where we get the 190. Now, remember that right now, if we don't do anything, we're going to carry this inventory at 220, but we know that we need to apply the lower of cost or market. So we need to get that 220 down to 190. And we do that through that journal entry, right? We have to reduce it by $30,000. Okay, there's a need to know. I think I'll do that for you. So how are we going to do this? Here's our units. And here's the cost number in the market. Now they're going to make us go for it. So again, 5 units at a cost of 1,000, that's 5,000. 5 units at the market of 800, that's 400,000, and we cost it out. So that's kind of how it is. We do it again. 4 units at 500, that's 2,000. 4 units at 600, that's 2,400. And of course, we're going to take the lower of cost or market. So we're going to use the 2,000. Then we go 10 units at the cost of 400, that's 4,000. 10 units at the cost of 400, 10 units at the cost of 450, that's 4,500. And then lower of the 2, it's 4,000. So we'll take that. So at cost, we would be holding our inventory at 11,000, but we know that we should carry it at lower of cost or market. So we need to write it down by $1,000, right? We need to get down to 10,000. How do we do that? Then we're going to reduce the inventory by 1,000. And of course, the offset would be the cost of goods sold. Debit, cost of goods sold, 1,000. Credit, merchandise inventory, 1,000. Now, if we make a mistake in our inventory count, that's going to have an effect on our current and future financial statements. So I'm going to teach you about the effects of it, right? And what would cause an inventory error? Well, you fail to count the right amount of items, or you price them incorrectly. Or perhaps you didn't recognize the transfer of legal title to goods in transit, right? All these errors are going to affect both the income statement and the balance sheet. So what we're going to do is do this little handout. I think it's really good. You have this one. Hopefully you're going to bring it. There we go. Should I make this bigger? Yeah, we'll make it big there so you can see it. Okay, let's say that this is the correct information. Beginning inventory of 30 plus purchases of 40 is amount available of 70 minus ending inventory of 30 equals cost of goods sold, right? The amount available is 70. We counted 30. That's what we have remaining. So we had available of 70, only 30 remaining. Cost of goods sold is 40. But let's say we screw up and we don't have the right inventory. Instead of 30, we count only 25. Well, if any inventory is understated, what happens to cost of goods sold? Well, now it's instead of properly 40, it's now 45. So cost of goods sold is overstated. You see that? It should have been 40, but because we had the inventory was understated, our cost of goods sold is overstated. Now think this logic. If cost of goods sold expense is overstated, the expense is overstated, net income is understated. Makes sense? If your expense is overstated, your net income is understated. Okay. Now we have to answer this question. Does the inventory error wash out over a 2-year period? Yeah, it does. But let me show you how it works. We're assuming we have one error only. So this is the error we made, the ending inventory in this period. Well, this ending inventory becomes the beginning inventory of the next period. So let's run that scenario through. Because we're moving that mistake over, this ending inventory becomes the beginning inventory of the next period. Then look the effect of amounts available. Now it's only 65. So if you price that out, this is only air. So we did count the ending inventory correctly, but still, because of that beginning inventory error, our cost of goods sold is now what? Understated. So does the inventory error wash out? Well, yes, because look, over two periods, your cost of goods sold would have been 40 plus 40, which is 80. And with the error, you overstate in the cost of goods sold here 45, and then you're going to understate it here with the total cost of 35. But 45 plus 35 is still 80, right? So it washes out. In one period, your cost of goods sold is overstated, and the other one, it's understated. But together, they wash out. Let's take a look at this one. Let's say that our ending inventory now is overstated. Oh my goodness. We should have counted 30, but we counted 50. What's the effect on cost of goods sold? This inventory where we overstate our ending inventory. Well, notice here, 70 minus 50, it's 20. My gosh. So when ending inventory is overstated, cost of goods sold is understated, right? It should have been 40, but now it's 20. It's understated. Okay. Now, if cost of goods sold expense is understated, the expense is understated, net income would be overstated. Now, does that one inventory error wash out over 2 years? Yes, it does. Let's check this out. That ending inventory error, that overstatement, right? That ending inventory becomes the beginning of the next period. And if we play that out, notice that amount available is 90. It should have been 70, but now it's 90. So when we take amount available and then we put the right inventory amount in, because we did the second period, we did do inventory right. The only error we made was here in the first period. But notice that as we play it out, that that beginning inventory, it's really overstated. That means our cost of goods sold is overstated. Now, does it wash out? Yes. Over two periods, the cost of goods sold expense should be 80, right? 40 plus 40, that's 80. Here, it's 20 and 60. It's still 80. So it's going to wash out. So this understatement of cost of goods sold in the current period and the next period will be an overstatement, but the two will offset and everything will be fine. Okay. Okay, this is a big slide. Really, what you really need to write down, because it's going to help you so much, is just the highlighted part. You can study all of it, but I'm telling you, this is what you need to know. There is a direct relationship between beginning inventory and cost of goods sold. A direct relationship. And what I mean by that, if your beginning inventory is overstated, your cost of goods sold will be overstated. Can you remember that? It's a direct relationship. You overstate beginning inventory, you overstate cost of goods sold. Now, there's an inverse relationship or an indirect relationship between ending inventory and cost of goods sold. So when one goes up, the other goes down, basically. Here we go. If you overstate ending inventory, then you understate cost of goods sold, right? So you overstate one in ending inventory, it understates cost of goods sold. All right. Now, I'm going to show you something that's going to help you do this. This is something I kind of developed when I was a student, and it's really wacky, but it really works. For the test, I was freaking out because I said, well, they gave me this. What's the effect of the ending inventory error, an overstatement? And I was really flipping out. So I came up with this method. Notice that this would be my left hand, beginning inventory, and under that is my right hand. And so I have the distance between my hands is, I thought of cost of goods sold. Okay. So when the question is, what happens if my ending inventory is overstated? This ending inventory is overstated. It goes up there, right? So it goes up. And what's the effect of my overstatement of ending inventory? My cost of goods sold is understated. The distance between my hands are less, right? So, and ending inventory overstatement would cause the cost of goods sold to be understated. Overstate ending inventory, understate cost of goods sold. There's an indirect relationship. Likewise, what would happen about beginning inventory? Okay, here's my left hand, and under my left hand is my right hand. And I'm saying that beginning inventory is overstated. So it's going to go up, right? So if that happens, it goes up. Well, what happens between the distance between my hands, right? Well, cost of goods sold goes up too. There's more space there. So then I conclude, okay, that means that if beginning inventory is overstated, cost of goods sold is overstated. There's a direct relationship. Let's check this out. And if you can do these problems, then you have nothing to fear on the test. Assume that in year one, inventory is overstated by 50,000. Okay, ending inventory is overstated. So we know if ending inventory is overstated, cost of goods sold has to be understated, right? There's an inverse relationship, a direct indirect relationship. Okay, let's put it in there. Okay, ending inventory is overstated. Now, beginning inventory, well, it's correct. We have one error, our ending inventory. Now, if ending inventory is overstated, cost of goods sold must be understated. Why? Because there is an indirect relationship. If ending inventory is overstated, cost of goods sold is understated. Now, if cost of goods sold expense is understated, the expense is understated, net income must be overstated. And if net income is overstated, well, stockholders' equity is going to be overstated, right? Because net income will increase the equity. Okay. Now, what happens in year two? We have one error, right? So, and it's the ending inventory in year one. So that ending inventory is going to become the beginning inventory of year two. But for the ending inventory of year two, it's correct. But the beginning one, well, that error is going to float over, right? The ending of year one becomes the beginning of year two. So if year one is overstated, the beginning inventory of year two must be overstated, right? It carries over. Now, here we go. If beginning inventory is overstated, what's cost of goods sold? Remember, there's a direct relationship between beginning inventory and cost of goods sold. If beginning inventory is overstated, cost of goods sold must be overstated. Okay. Now, if cost of goods sold is overstated, the expense is overstated, then what's net income? It'll be understated. You had too much expense, so net income is understated. Well, what's the effect of stockholders' equity in year two? It's correct. What the heck? Well, let me tell you why. Remember, the error washes out. Equity was overstated right here because of the net income. But see, remember, net income was overstated here, but it was understated. So these two wash out. So your stockholders' equity is going to be correct. Let's try one more. Let's assume that ending inventory is understated by 25,000. Okay, so ending inventory is understated. Beginning inventory, well, it's going to be correct. All right. Now, if ending inventory is understated, what's going to be cost of goods sold? Overstated. Remember, there's an indirect relationship between ending inventory and cost of goods sold. If cost of goods sold is overstated, the expense is overstated, net income must be understated. And if net income is understated, stockholders' equity is understated. Now, what would happen in year two? Well, we only have one error, and it's the ending inventory of year one. So the ending inventory count of year two is going to be correct. But that beginning inventory, well, we got that number from, the ending of year one, because the ending of year one becomes the beginning of year two. So if it's understated, ending inventory is understated in year one, beginning inventory is going to be understated because it's the same number. We're just bringing it over. The ending inventory of year one becomes the beginning inventory of year two. Now, if we understate beginning inventory, then what's the effect on cost of goods sold? Well, there's a direct relationship between beginning inventory and cost of goods sold. So if beginning inventory is understated, cost of goods sold is understated. Okay. Now, if cost of goods sold is understated, the expense is understated, the net income must be overstated. Now, I'll see if I'll catch you on this one. At the end of year two, stockholders' equity will be correct. It's a wash, right? Because net income was understated in year one, it was overstated in year two, so it's a wash. But at the end of year two, your stockholders' equity will be correct. Okay, so this is kind of how your book explains it, so you can kind of look at that. I don't think I'm gonna spend too much time because we just kind of did that. So same thing. This is how your book explains it. All right, see if you get this. Understating ending inventory will overstate cost of goods sold. Remember, there's an indirect relationship between ending inventory and cost of goods sold. Understating ending inventory will overstate cost of goods sold. Okay, now I'm going to give you a couple of financial statement analysis ratios. And this is how we use some of the data, right? Managers, you guys are going to want to know how fast your inventory is turning over. You want it to move. If your inventory is not moving, then you need to buy different inventory. So you want the high inventory turnover. And how do we calculate that? By cost of goods sold divided by average inventory. Okay. And how do we do average inventory? Beginning inventory plus ending inventory divided by 2, and plug that number in your denominator and just do the calculation. And we're going to do one in just a second. So an application, so you see how it works. Then let's do the next one. Well, actually, let me explain this again. It shows how many times a company turns over its inventory. It's an indicator of how well management is controlling the amount of inventory available. Yeah, so you want managers, you want your inventory to be moving and turning over, right? Okay, now this one kind of is kind of wacky. I always had a hard time as a student understanding. I kind of do now, but I think for you, I want you to focus in on what it's saying. Basically, this days sales and inventory reveals how much inventory is available in terms of the number of days sales, right? So basically, ending inventory divided by cost of goods sold. So let me just share with you what I mean by that. Okay, that inventory turnover here, Costco, it's turning over 11.8 times. In this one, you want it a high number. The more it turns over, the faster it's moving. Notice here that Costco is doing much better than Walmart, because Walmart their inventory only turns over 8.8 times. So they're doing better. Now, this days in sales. So basically, this is like how many days that the company can survive before they run out of inventory, right? So Costco can survive 31 days. Walmart can survive 41 days. And you think, well, man, I want to be Walmart because I want to survive, with 41 days. And that's, well, not necessarily. See, what you're trying to do, managers, you're trying to keep as little inventory as you can, because when you buy inventory, it's costing you to hold that inventory. So you try to do the minimum that you can, but then again, you don't want to run out. That's a problem too. It's a balancing act. So you just can't say, well, Walmart's doing better because they've got 41 days in sales. Well, it looks like if Costco is not experiencing any shortages, they're doing a better job because they only have 31 days sales in inventory. So I think all in all, it looks like Costco is much more efficient than Walmart. Okay. And then let's see what we do. All right. So let me show you an application of how to, figure out inventory turnover. And that's on Quick Study 5-25 on page 230. 5-25. That's at the bottom of page 230. Okay, so we know that inventory turnover is going to be, cost of goods sold divided by average merchandise inventory. Now, the thing is, before you do the calculation, you divide it into the, cost of goods sold, you got to figure out what beginning and ending inventory is. So in this case, beginning inventory is 140,000, ending inventory is 180. Add the two, looks like that'd be 320,000. 320,000 divided by 2, and that number is what you can divide the cost of goods sold. So do that, and you should come up with 7.50. So you got to figure out average merchandise inventory first before you actually, divide it with the into the cost of goods sold. All right. As far as days in inventory, that's simply ending inventory, which is 180,000, divided by cost of goods sold, which is 1,200,000, and get that figure, and then multiply by 365 days. So in this case, you're going to have 54.75 days in the inventory. Okay. Okay, that does it for me for chapter 5. So hope you enjoyed the video lecture, and we'll see you next time. Bye-bye.